Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. So the market now closed above 1,500 as far as the S&P 500 index is concerned, back on Friday. What's next? We're going to try to find out from Tracy Reineck, our stock strategist in the value category, our ETF strategist Eric Dutrem, and our senior equity strategist Kevin Cook. And Eric, I'm going to start with you. So the question that I had posed off camera was 1,500, is this just a psychological level or is there something more to it than that? You say it's only psychological and a pretty weak one at that.
Exactly. I think investors should really key in on the 1565 mark, which is the S&P 500's all-time high, I believe in 2007. And I think that's the real psychological test. This 1,500 number,
weak.
It's weak. It's not really, it doesn't really mean anything. People are just attaching a lot of significance to it just because it's a nice round number.
So now I just saw the hair on the back of Kevin Cook's neck stand up the minute you said it was weak. Kevin, psychological?
Oh, purely psychological.
But does it carry any other importance besides psychological? It does, for two categories of people.
Well, yeah, people who, for bears and people on the sidelines.
Okay.
Because it's like, oh man, this could be for real.
Yeah.
You know, this rally, it has been built in place for the past few months for fundamental and technical reasons. Mm-hmm. You know, you've got the U.S. economy improving. You've got Europe stable, so you can say that contagion is removed. You've got China, no hard landing, mm-hmm. so you've got a tailwind restored.
Right.
Put that on top of the U.S. tailwinds. And then U.S. policy is, the obstacle is almost removed. So you take all this stuff out of the way, and fund managers are like, wow, there's a psychological freedom now to get fully invested. And any of them who are starting to feel like they're left behind will be running to buy. And that's why we've seen the Russell and the mid-cap, we talk about it all the time. Those made new highs even before the S&P got above 1470.
Yeah.
So this rally is for real. And I think we'll see 1525 on the S&P before we have a pullback to 1450.
All right, I'm going to get back to that in just a
Sure.
minute. Tracy, you say it's psychologically important until we achieve it, then it becomes irrelevant. Is it irrelevant yet?
Yes, within like 1 day it is, I think. It only took us 2 times to close above it. And, we'll see what happens this week, obviously, but we're already past it. Like, I agree with what Eric said. We're going towards the next high in the S&P 500. Mm-hmm. But I've been following what Kevin has said. We've been talking about it a lot amongst ourselves, is the small caps and the mid caps. Those broke out to like all-time highs a couple weeks ago.
And that's where the risk is.
Yes, and if everybody's pouring into those and they're still pouring into them, nobody's afraid, and that's a good sign for this
And to clarify,
rally.
that's where the risk appetite is. When you
Yes.
see, that's the breadth and depth of the market. I call the Russell and the mid the other 2,400 stocks,
All
right? And if money managers are piling into there, that shows you 2 things. That's optimism about the economy, and it's technically good for the market that they're investing broad and deep across all sectors and market caps.
All right, I want to get back to your comments about levels in the S&P.
Mm-hmm.
Your bumper sticker says, I buy dips because you see a 60% chance that we're going to see an S&P 1600 before 1400. Mm-hmm. My research shows we saw 1500 for the first time on March of 2000, and it's taken this long since then to close above it. So I ask you to justify your case.
And you look at that chart, 2000, and we go down and this and that. Some technicians call that an expanding triangle. It just keeps getting bigger. And if the secular bear market isn't over, we could still make new highs and come back down in a big bear correction. But right now, you can't play it that way. And money managers aren't. You have to follow the money. And we are probably, I think we'll see 1550 in the first quarter here. Mm-hmm. And we're certainly due for a pullback. The Dow and the S&P, or at least the spiders, are setting records with 12 green days in a row. That's a new record. So that kind of thing, it can go on. We saw it in the 90s. We've seen it at different periods in 2006, maybe 2003. And it's sort of a train that's getting away from people. And once we suck a few more bears and sideliners in, then we'll probably have a 3 to 5% pullback and then on to new highs.
Okay, so we've got a lot of interesting economic indicators coming out this week. Eric, what are you going to be watching?
I think it's really it's going to be the totality of them, along with the earnings. That's what I'm really focused on, is how the rest of the market does, because it's been a pretty solid one so far, especially in financials. So I'm going to be looking to see how the rest of the financial space does, see if they can kind of keep up this trend and push the market higher.
Okay, Tracy, what are you watching this week?
I'm also watching earnings, although this week it's not quite as heavy as what it'll be the next week after. I mean, we're still getting a lot of earnings reports, but it's not quite as heavy. But we are getting some other economic indicators, like job data is coming out again.
First pass of the GDP for
Yeah,
first quarter.
so that is always something that everybody's watching. But as long as it stays on that trend of some slow improvement, then it's really all about earnings.
And we just had durable goods this morning with a
Right.
big beat.
Yeah.
So
your radar screen for the week looks pretty much similar to this?
yeah, we're going to watch earnings. There's no geopolitical global fear, so we don't have to worry about that. It's really about the domestic U.S. data and earnings. And if Caterpillar warned last week, this morning they came out and actually beat the new consensus. Although their guidance was a little weaker. They're guiding $7 to $9 for the year when the street's at $8.54, but the market's taking it pretty well.
Okay. Thank you all for that. Don't forget that these folks are kind enough to bring you their weekly top picks list, and that is in our next segment that you'll want to click over to.